Welcome to the Deep Dive, the show where we cut through the noise and get you straight to the heart of what truly matters. Today, we're pulling back the curtain on a company most people don't know by name, but without it, the smart device in your hand, the AI driving data centers, even the navigation in your car simply wouldn't exist. We're talking about ASML, the invisible force behind pretty much every modern chip. Our mission for you today is to, well, thoroughly explore the business, the financials, and the future of ASML, pulling together everything we've learned from our research. By the end of our conversation, you'll be armed with, hopefully, crucial insights into a company that undeniably sits at the very core of the global tech world.
It's really quite something, isn't it, how one company can be so absolutely foundational to an entire industry. ASML isn't just another tech player. They hold a near monopoly on the highly specialized technology that is indispensable for manufacturing the most advanced chips we rely on daily.
Okay, let's unpack what makes them so indispensable. At its core, ASML is the world's dominant supplier of semiconductor lithography systems. Now, if you're picturing a complex factory floor, you're on the right track. Photolithography itself is essentially like using light to etch incredibly tiny, intricate patterns onto silicon wafers.
Right, creating the microscopic circuits that become chips. Think of it like taking a highly detailed photograph and shrinking it down to an almost atomic level, then carving it onto a piece of silicon. It's pretty amazing stuff.
And this isn't just about making any chips, right? It's about the cutting-edge ones.
Exactly. It's about enabling the high-performance chips, driving everything from AI to, well, maybe even quantum computing down the line. ASML's virtual monopoly is particularly pronounced in extreme ultraviolet, or EUV, lithography. That's the real bleeding edge.
And these machines, they're expensive.
Astronomical is the word. Somewhere between 150 and 300 million euros each.
Wow.
Per machine? Per machine? To put it another way, if a large jetliner costs around, say, 100 million euros, these are 2 or 3 times that price. And they're not mass-produced. Only a few hundred are sold globally each year. Like in 2024, I think the number was 380 new systems and maybe 38 used ones delivered.
That few. That really highlights their unique position then.
Absolutely. Almost irreplaceable in the global supply chain for advanced chips.
So how does a company selling just a few hundred, albeit incredibly expensive, machines generate such impressive revenue? What are their actual income streams?
It's quite a clever model, actually. About 77% of their revenue comes from those new and used system sales. This includes their established RF immersion systems, which are crucial for many, let's say, mainstream chips, and their cutting-edge NX-EUV systems, the ones we just talked about.
Okay, and the other 23%?
That comes from what they call installed base management services. So essentially, the recurring revenue from maintenance, upgrades, spare parts, keeping these incredibly complex machines running smoothly.
So service contracts, basically.
Pretty much. And their customer list reads like a who's who of chip making. TSMC, Samsung, Intel, SK Hynix, Micron. You name a major player, they're likely a customer.
That's a powerful combination. Product sales and then ongoing service revenue. But, if they're selling to all the big games, is there any customer concentration risk? Does one player dominate their order book?
That's a vital question, and yeah, there is. While they have a global customer base, there is indeed significant concentration. Their top 3 customers, that's TSMC, Samsung, and Intel, account for approximately 65% of their orders and receivables.
65% from just 3 companies.
Yep. So this raises an important question. What does that concentration mean for their business? Especially if one of those giants, hits a rough patch or decides to cut back on spending. From our sources, it's a known risk they manage, but it definitely ties their fortunes pretty closely to a few key players.
Okay, the market dominance is clear, but how does that translate onto the balance sheet? Let's take a look under the hood at ASML's financials, because the growth here has been, well, nothing short of astounding.
Absolutely. Their revenue, for example, soared from about $6 billion back in 2012 to over $30 billion in 2024. That's huge growth.
Especially those last few years, right? 2021 to 2023 saw big jumps.
The massive jumps. And we connect this to the bigger picture. These are truly the hallmarks of a company with a significant competitive advantage, a real moat. We see consistently high gross margins hovering around 53, 55% in 2024, and net margins ranging from 25-30% in recent years. Really strong profitability.
Expert, these numbers are incredible. What's the real story behind such exceptional capital efficiency? Is it just the monopoly, or is there something else strategic going on, like how they leverage R&D or that installed base?
It's definitely a combination. That monopoly is key, no doubt. But the returns on equity have been exceptional, too, spiking to like 58, 63% between 2021 and 2023, and still a very strong 41% in 2024. And their return on invested capital, or ROIC, that's around 24, 27% trailing 12 months. Now compare that to their estimated cost of capital, their WACC, which is maybe around 14.8%.
So they're generating returns way above what it costs them to get capital.
Far, far above. It tells us they're not only selling extremely valuable products, but they're also incredibly efficient at deploying capital and generating profits.
Yeah.
That tech moat and the recurring service revenue are huge drivers.
And beyond the profits, what about the balance sheet itself? Debt levels.
Cash. Oh, it's incredibly robust. They operate with very little debt. Their debt-to-equity ratio was sitting at roughly 0.23 in 2024. Very low leverage.
And they're sitting on cash.
Big piles of cash and short-term investments, ranging from $4.8 billion up to $7.0 billion recently. That gives them a lot of flexibility for R&D, buybacks, or just navigating any potential downturns.
Right, that makes sense.
And delving into their cost structure helps illustrate their moat even further. Research and development is a massive fixed cost.
Oh, massive.
Roughly 1.0 to 1.2 billion per quarter. Over 1.1 billion just in Q1 2025 alone.
What?
This continuous high investment in R&D is precisely what fuels their technological edge. It keeps them years, maybe even decades ahead. On the variable side, materials for the machines are the dominant cost. ASML spends about 15.5 billion annually just on suppliers.
Okay, so we've talked about their incredible dominance, impressive financials. Sounds almost too good to be true. No company is without its challenges, right? What are the significant headwinds and risks ASML faces?
You're right. Even with such a powerful position, they're not immune to the inherent cyclicality of the semiconductor industry. We're talking about things like memory and DRAM inventory corrections, or just broader slowdowns in capital spending from the chip makers themselves.
So when the industry sneezes,
ASML can catch a cold, although given how essential they are, it's usually maybe a milder cold than some others might catch.
and perhaps the most talked about risks right now are geopolitical. What impact are things like US and EU export controls and tariffs having? This seems like a big one.
It's arguably the most pressing challenge right now. China, for instance, accounted for roughly 26% of ASML's 2023 sales.
A quarter of their sales. That's significant.
Very significant.
Huh.
So any major clampdown on sales to that region, particularly for the advanced EUV systems, could definitely impact their revenue stream. Management themselves noted in their Q2 2025 earnings remarks, increased geopolitical uncertainty could affect shipment timing. It's a delicate balancing act for them.
Navigating global trade tensions while serving a worldwide market, tricky. Beyond the big picture geopolitics, are there any more immediate sort of day-to-day operational risks they've had to navigate?
Well, in the shorter term, they've dealt with supply chain issues.
Yeah.
Like remember the neon gas shortages a while back that
Yeah.
affected the whole industry?
I remember that.
Though they've been actively diversifying their supply lines since then. And of course, currency fluctuations can always put a bit of pressure on margins, just given their global operations. Standard stuff for a multinational.
Looking further out then, that technological moat seems impenetrable right now. But is there any scenario, however remote, where a competitor could emerge? Maybe with a totally different chip-making approach. Especially if these trade barriers persist and incentivize alternatives?
That's a fair question. Look, there's no immediate EUV competitor on the horizon. The barriers to entry are just immense. But yeah, prolonged trade barriers could theoretically inadvertently incentivize countries, especially China, to invest massively in alternative patterning technologies. Over the very long term, that could potentially chip away at ASML's market share. It's a long shot, but not impossible.
And the customer concentration risk comes back into play there too, I suppose?
Exactly. If their top clients face severe cutbacks for whatever reason, ASML feels it. And, people talk about the slowing of Moore's Law. That's a long-term consideration for the whole industry.
But is that a major threat right now?
It seems balanced, at least for now, by sustained demand from all these emerging markets, AI, 5G, automotive tech, the Internet of Things. They all still need more and more advanced chips, so the demand picture still looks pretty strong.
Okay, so with such a critical position and these complex global dynamics at play, it really begs the question, who is actually steering this ship? Let's dive into ASML's leadership team.
Right. The current management team is led by CEO Christophe Fouquet. Roger Dawson is the CFO, and Frederick Schneider-Monori is the COO. They generally have a solid track record of meeting their targets, and they tend to provide pretty conservative guidance. They're also quite open about acknowledging challenges like those geopolitical uncertainties we mentioned.
Seen as steady hands them.
Very much so.
What about insider alignment? Do the executives have skin in the game? And maybe more interestingly, what does their recent activity buying or selling shares suggest about their confidence?
Yeah, it's a bit of a nuanced picture there. Insiders certainly hold stock, which is good alignment. However, we have observed some recent activity, particularly late 2024 and into early 2025, showing key executives, including the CEO Fouquet, actually selling shares. Around 0.7 million jawed worth each, roughly.
Selling, How should we interpret that?
Well, it doesn't necessarily scream a lack of confidence. Executive compensation is often heavily stock-based, right? So selling shares can simply be part of their long-term compensation strategy. Or maybe just for personal liquidity needs. Diversification.
True. It doesn't automatically mean they think the stock is peaking.
Exactly. But
Yeah.
it does suggest they aren't aggressively buying on dips either, which, some investors might see as a sign of really strong long-term conviction. So it's something to note, but maybe not overinterpret.
Got it. And when it comes to the big institutional shareholders, who are the major players and how do they typically interact with management? Do they push back often?
We're talking about the usual giants here. BlackRock holds about 7.1%. Vanguard has roughly 4.2%. These funds obviously wield significant voting power, but our sources suggest they largely align with management's vision. At ASML's 2025 annual general meeting, for instance, all the management proposals, things like the final dividend, share issuance authorization, buyback authorizations up to 10%, they all passed unanimously.
So strong institutional support by the looks of it.
It seems that way, yes.
ASML also has a pretty consistent history of share buyback programs, doesn't it? What does that tell us about how they think about capital allocation?
It does. Their current program, running from 2022 to 2025, authorized $12.0 billion in repurchases. That's a big number. By the end of 2024, they had already repurchased about $6.14 billion worth. The pace might have slowed down a touch recently, but it clearly highlights a commitment to returning cash to shareholders.
Which makes sense given the massive amounts of cash they generate.
Exactly. What else are you going to do with it after funding that huge R&D budget?
Yeah.
Buybacks are a logical step.
Now for the big question, the one every investor grapples with, the valuation puzzle. How is ASML valued in the market right now? Especially considering its incredible growth. You mentioned that $30 billion market cap in 2014. Now it's way up, around $300 billion today. That's a tenfold increase.
Yeah, and that raises the crucial question, doesn't it? Do these current multiples leave enough cushion, enough margin of safety for new investors coming in today? Because ASML definitely trades at elevated valuation multiples. Its price-to-earnings ratio, the PE, was about 33x based on 2024 earnings. Its price-to-book ratio was around 13.6x.
And those are high compared to historical levels, or just high generally?
Both, really. To put it in perspective, its PE actually peaked higher, around 48x back in 2020, and its PB hit nearly 26x in 2021. So it's come down a bit from the absolute peaks, but still, these are significant premiums compared to many other industrial or even tech companies.
So from a traditional value investor perspective, someone like a Buffett or a Grantham, looking for deep discounts, what's the likely view on ASML? We don't see them reported as holding big positions. Why might that be, given the strong financials we just discussed?
It's an interesting point. ASML certainly ticks some classic quality boxes that value investors, like strong free cash flow, high returns on invested capital, that incredible moat. But its high absolute valuation likely deters those classic value funds who are really hunting for that significant margin of safety.
You mean buying something for, say, 50 cents when you think it's worth $1?
Exactly. When a value investor looks for that 30%, 40%, 50% discount to what they believe the company is truly worth that cushion against being wrong or things going sour, ASML's current price just doesn't offer that. It would simply be too high for their strict criteria.
So if we tried to apply maybe the Buffett method, thinking about intrinsic value using a discounted cash flow analysis at DCF, what does a conservative look suggest?
Well, if you run a conservative DCF, even assuming a 0% margin of safety, you're willing to pay exactly what your calculation says it's worth today.
Which is pretty optimistic.
Right. Even then, the current stock price, around $750 or so, implies pretty low expected future returns, maybe low single digits annually. And if you apply that more typical 30–50% margin of safety that a value investor would demand, your buy range drops significantly lower, maybe somewhere down between, say, $250 and $500 per share, a long way from where it trades now.
Okay, so what does this all really mean then? How should investors think about ASML?
I think ASML is likely best viewed as a growth and quality name, rather than a pure deep value play based purely on these metrics. It's a fantastic, dominant business, no question. But you're paying a premium price for that quality and for the expectation of continued strong growth.
Makes sense. It's buying quality at a fair price, maybe, rather than a fair company at a wonderful price.
That's a good way to put it, yeah.
Okay, let's bring it right up to the present then. A quick snapshot of their latest financials. The Q2 2025 earnings that just came out. What did those numbers look like? Any key takeaways?
Yeah, they continue to perform very well. ASML reported net sales of $7.742 billion for the quarter. Net income came in at $2.355 billion, which translates to $6 billion per share.
And margins held up?
Yep. Gross margin remained strong at about 53.7%. Perhaps even more telling for the future, they also reported robust new bookings of $5.54 billion for the quarter, and significantly, 42% of that was for the high-end EUV equipment.
So demand for the cutting-edge stuff is still strong.
Exactly. It builds their total backlog to a very hefty $55 billion. That provides a lot of visibility. Management guided for Q3 sales between 7.4 euros and 7.9 billion, and they also affirmed their expectation of about 15% sales growth for the full year 2025 compared to 2024.
So still projecting strong growth.
Yes, but they did reiterate that caveat we discussed, that increased geopolitical uncertainty could potentially affect shipment timing down the road,
Yeah.
so it's still a factor they're watching closely.
Okay, so wrapping things up for you, our listener. ASML clearly stands as an undisputed leader. It has an incredible technological moat, exceptional financial health, and a really strong track record of growth. It's truly a linchpin of the modern tech world. However, its current valuation demands continued high performance, and it faces very real geopolitical and cyclical headwinds that definitely bear watching closely.
So maybe the final thought to leave you with is this. Given ASML's unique position right at the heart of the global chip industry, but also considering its, let's say, rich valuation and the political crosscurrents it has to navigate, how might you weigh that long-term potential against the more immediate risks? What stands out to you as the single biggest factor for its future? Something to ponder.
Indeed. Thank you for joining us on this deep dive into ASML. We really hope this conversation has given you a clearer, maybe more nuanced understanding of this crucial yet often unseen giant of chipmaking. Keep exploring, keep learning, and hopefully you can apply some of this knowledge in your own analyses. And just a quick reminder before we sign off, all the analysis and data we've discussed today are based on publicly available sources, and they may be subject to revisions or differing interpretations. This content is purely for educational purposes and does not constitute investment advice. Please always conduct your own due diligence before making any investment decisions. Remember, past performance is not indicative of future results, and investing always carries the risk of loss. Okay, thanks again for tuning in.